Okay, welcome to the run through of the weekly S&P 500 chart storm. What I'm going to do in this video is take you through the latest chart storm and add a little bit of extra comments and context around the charts. So just straight into it. Number one here is, so I'll read out the tweet first and then I'll blow up the chart and talk through it. That's the format. So while the S&P 500 has gone on to new highs, Treasuries, Commodities and China A shares do not share the same enthusiasm. So we'll open that up. And so what we've got here in the candlesticks is the S&P 500 itself, and in the black lines overlaid is, well, there's a few different things here, but basically we've got TNX there, 15.8, so that's Treasury yield. It's a little bit weird how they display it. I'm not sure exactly why they do it like that, but it's basically 1.588. It's the yield. Anyway, now just one thing to clarify. Most of you should know this, but yields move inversely to price. So what that actually means is that treasuries have actually rallied sharply there. But I've displayed it like this just to be consistent with the signal. Treasuries rallying is basically the opposite of the others. The reason that is, treasuries tend to do better when there's risk aversion. They tend to rally when growth and inflation expectations fall. So that's kind of what's going on there. The other things in this chart is ASHR, so that's at 28.37. That's China A share ETF. And then of course DBC, which is 15.88, so that's, oh sorry, that's 14.65. So that's a commodity ETF. Basically, the point here is that there was a much greater impact in anything, just about anything that's not the S&P 500. And you know, there's ways that we can kind of explain that, I guess, or you know, in hindsight, explain it. Commodities, China A shares, obviously these things are much more closely connected to the China market, the China economy, and so you know the real hit to growth there has a more direct impact on those assets. Definitely has an impact on the S&P 500, as we'll look at in the next section, but the point there is that it's kind of the direct versus indirect effects, and then the treasuries aspect, well, you know, it's reflecting some probability of growth having a hit there, but it's also kind of pricing in worst case scenario, reflecting kind of the broader risk off situation, risk aversion situation. On to the next one, and this one kind of carries on from that a little bit. So as for the virus, companies are certainly talking about it. 138 out of 364 so far of companies, or 38%, have discussed coronavirus in their Q4 earnings calls from January 1st to February 13th. And so this chart provides a breakdown per sector. So obviously healthcare, it's probably a positive thing for them. So they're obviously going to be talking about that. Industrials, they're kind of, you know, going back to that previous chart, probably on the pointy end. So same thing with technology. So industrials probably more so on the demand side. IT probably more so on the supply side in terms of supply chain disruption. And then the rest of the materials, obviously that's more or less commodities, same thing with energy. So, you know, it would be wrong to say that it has no impact, but the market's saying that the impact, you know, it's basically looking through it versus commodities. See, that's the other thing, is that you find that, going back to this chart, you actually find that equities tend to be a lot more forward-looking, more happy to look through the sort of worst case immediate scenario, whereas commodities are much more of a here and now, what is the current spot demand and supply situation. So equities more anticipatory, commodities more of a current reality check. Same thing with bonds, really. I mean, you know, bond market's supposed to be this big, great forecaster, but it's much more swayed by the you know, day-to-day market sentiment and data flow. Number 3, but traders seem happy enough to pile into calls, though. And so, but I've put it here in brackets, it's a very stark chart, but given the tail risks, which, you know, the tail risk to the first two charts is that, you know, the virus becomes a much more widespread problem than it currently is. So anyway, yeah, very stark chart, but given the tail risks, calls, so call options are probably a good way to get exposure if equitizing cash, less so if outright speculating. So the point there is that, you know, if you're outright speculating, then obviously call options allow you to know the exact amount that you can lose. Of course, the issue with that is that you definitely can lose 100% of your call premiums. Versus equitizing cash. So equitizing cash, what do I mean by that? It basically means if you've got, say, 10 grand in the account, then you go and buy options that give you a notional value of 10k, so that basically you've still got your cash sitting there, but you've gone and bought, well, you probably would have taken some of it to buy the call premiums and basically get the equivalent of putting that 10,000 straight into equities. But, you know, I mean, the other way to look at that is that you basically bought a put option. Bit of financial engineering, but anyway, let's look at the chart itself. So what it is the total calls bought to open minus calls sold to close. Basically demand for call options, really. I mean, and it's surged, so there's not really much else to add there. People are getting after it. Number 4, what virus? The TD Ameritrade Investor Movement Index, which is a measure of sentiment, ticked up in January. So their index here, I'll get onto my one in a minute. Their one based on retail trader accounts, because so these guys, TD Ameritrade, massive online broker, that gives them the advantage of having this, you know, metadata in their client accounts that they can perform this kind of analysis on. And as you can see there, it ticked up slightly further in January. Not panic by any means, really. I mean, if anything, the predominant mood there would be one of at least a mild case of FOMO, if not a much larger case, fear of missing out, that would be. And very much similar, which is always good to look at two different versions of basically the same kind of indicator or the same kind of information. This is my own sentiment indicator here, which I call the Euphoria Meter. Ticked up further in both January and the February flash reading, and it's now actually just slightly higher than where it got to in 2015. So we'll have a look at it. As you can see there, just slightly higher than where it got to in 2015 peak. As a side note, it took a while for the market. The market kind of peaked shortly thereafter, but it took a while before it actually went into correction mode. It's the thing when you're in an anticipatory market like equities, you do tend to look through the noise until, you know, or the short-term issues until it becomes clear that it's actually less of a short-term issue, and then, you know, it all falls apart. But there are other times where, for example, which is very different top back there in January 2018, there was more of a frenzied top there, but there was a few other things going on. Anyway, what is this? It's a combination of these three things down the bottom, which is forward PE, bullish sentiment from the AAII and the II surveys, and a smoothed version of the VIX, inverted. And the reason why I've included these various different components is because I wanted to have a surveyed measure and basically two different market measures. You know, the forward PE is a valuation metric, but you can also think of it as a sentiment metric, which I've done so here. And you can see there that it will certainly the troughs in this indicator line up with the market bottoms, and you know, the peaks a little bit less so because there's a bit more, as I kind of referred to or alluded to earlier, there's a bit of nuance to it. But you know, I would say if you look at what else is going on, it can be quite a useful indicator. You can see there in the early 2000s, you know, it wasn't until it basically gave you a big divergence signal that you know, became useful as a sentiment signal from the top side. But you tend to find that actually with sentiment indicators, they tend to give you much better information about market bottoms than market tops. You know, picking market tops is probably one of the harder things to do, or tends to be much easier to pick bottoms than tops. So anyway, I'll leave it at that for this one, but just note that information in passing. On to number 6. Similar to the first chart this week, while the S&P 500 index, the headline index, has made higher highs, the 50-day moving average breadth indicator has not yet done the same. So, and the reason why I say it's similar is because basically, you know, you've had the headline index move higher and some other corners of global markets, you know, not really voice the same kind of enthusiasm. So let's blow the chart up. So yeah, you can see there the higher high on the headline index and the lower high on the 50-day moving average breadth. So that's proportion of the S&P 500 constituents that are trading above their 50-day moving average at 65%. So it's basically 2/3. It's not insignificant, but you know, it does not speak to a massively broad rally. So in other words, 1/3 of the market are trading below their 50-day moving average, so you could say 1/3 of the market are not doing well. And what technicians tend to call this here little pattern is called bearish breadth divergence, and it can be a useful signal in picking turning points. Again, I tend to notice it works better in picking bottoms than tops, but you know, when the stars align, it can be quite a useful signal. And that's it for that one. So moving on to number 7, growth stocks trouncing value stocks. So it's the 3-month rate of change here, and it's the performance differential. Well, it's the 3-month rate of change of the grey line here, which is the growth versus value ratio. And you can see there that it's surged. And I won't go too much into that yet because I'll kind of cover it off in the next few charts. So we'll build on that. So number 8, similarly, the tech stocks versus S&P 500 ratio, weekly RSI, just hit the second most overbought reading of all time. And so again, we're looking at a technical indicator on a relative price performance ratio, which is the S&P 500 technology sector against the headline index. And you can see that it's had this run up, not quite the same frenzied run up as in the late 90s, but you know, when you look at it on an RSI basis, it's certainly starting to get that way. And so RSI, relative strength index, is a very useful technical indicator. The basic rule when you're using that is that readings above 70 are considered to be overbought, and you know, the higher it is, the more overbought it is, so the stronger the signal. Technically, I would note, in passing at least, is that the RSI oversold signal only really or becomes more significant when it goes up above 70 and then rolls over. That tends to give you a better overbought signal. And for reference, when it goes below 30, that's the oversold signal. Anyway, yeah, so we saw a bunch of these on the way to the top, also at short-term peaks. So, you know, in terms of trying to figure out whether this is a repeat of that, whether, you know, the currents versus the late 90s, certainly looking familiar, but, you know, I would probably look to this to help pick short-term peaks and troughs versus necessarily the major turning point, which, you know, you tend to need some other things like macro factors and whatnot. Number 9, also related, banking stocks just made a new all-time low relative to the S&P 500. So this one is almost the mirror opposite of the previous chart. We're looking at the banking sector versus the S&P 500, and clearly made a new low there. Not really much else to add to that. I guess it's just looking at the flip side of that previous one. You know, while tech stocks been doing really well, banking stocks have not. There's a few things behind that, obviously. There's structural factors like, you know, banks are just not as leveraged as they used to be. There was a big, massive credit boom that unwound back then. And then you got some of the sort of macro factors as well, like the yield curve is not as helpful for banking. And but I mean, credit conditions are not bad. So, you know, I wouldn't say that the macro environment is necessarily bad for banking, or at least the traditional banking. The other thing that you've seen is, you know, on the structural basis, is that a lot of the sort of higher risk banking aspects have been taken out and spun off. Like prop trading used to be a big thing for banks. That's now largely done in what we might call hedge funds. So a lot of the larger hedge funds are really just you know, a spun off bank prop desk. You know, where you have like a bunch of traders there, and, you know, they'll have $50 to manage, and, or 50 million, and they'll be trading with monthly performance windows, and basically the same kind of thing as a bank prop trading desk. So anyway, what does that mean? Banking stocks making a new low? Well, the contrarian, certainly part of me, is thinking, maybe there's an opportunity there from the long side. Certainly something to have a greater look at. Number 10, since we're on the topic, here's some of the long-term relative price performance perspective for value versus growth stocks. And I've updated in parentheses there. I put the link there. That's the link to Global Multi-Asset Investing 10 Charts to Watch in 2020. I might actually just pull this up real quick, because this will give you a bit of context about what I was thinking at the start of the year, which has so far not come to pass, but we'll have a look at it anyway. So number 9, value versus growth. The investment strategy graveyard is littered with failed calls for a turnaround in the performance of value versus growth stocks, but I think we could be close to the much awaited and much forecast turning point. Relative value between the two cohorts is at its lowest point in 20 years. That is, value stocks are the cheapest they've been in more than 2 decades against growth stocks, and you always want to pay attention to where relative value is when you're thinking about relative performance, because it can give you very good signals of longer term turning points. And in terms of macro catalysts, my expectations for higher bond yields, better growth and higher commodity prices will help the sectors that are slightly overrepresented in value versus growth. So my comment there is, don't forget about value. So that, I think, I'm still fairly comfortable with that sort of outlook. The comment that I'd make, or the self-criticism or the reflection that I'd make at this juncture, is that it's kind of been delayed by the virus, basically. I mean, growth was already starting to pick up, but, you know, it looks like Q1 is just going to be just obviously it's going to be crap. Q1, the data is not going to be good at all, and that's what we saw in that first chart this week with the price action in commodities, bonds, China A shares. So at the minimum, it's going to be delayed. But I think, you know, if the virus gets under control, obviously there's two kind of scenarios here, right? The worst case scenario is the virus gets out of control, becomes a global pandemic, and you have a much deeper and longer impact. The other scenario, which is my base case, is that, you know, it gets under control and has a largely localized impact, which is largely transitory. You know, the kind of profile that I would expect to see is that, you know, for example, China GDP would go real bad in Q1 and then come roaring back in Q2. And that's typically what you see in this kind of situation. So, you know, as a minimum, this is probably a theme for at least Q2, if not H2 this year. Still something to keep in mind and something to keep track of, which we are with these charts and which I am in my work as well. So that's it for this week. If you've got any questions, comments, feedback, make sure that you put them in the section below and be sure to follow the channel.